Hey everybody, in today's video, we're going to be talking about asset allocation. It's a critical part to your investing journey. I'm going to show you how I created my own asset allocation, how it works in my portfolio. We're going to buy some stocks, look at some dividends, and all the metrics about everything. If you're new here, my name is Darren, and this is the Crazy Canuck Investor, where I make investing easy for beginners. If you're like me, when I started, things were, not very simplistic. I didn't really know what I was doing, so I thought I would create this channel in order to help others get started. And I do that by sharing my journey with all my successes and experiences and even the bumps along the way. So without further ado, let's jump right into the video. All right, so jumping right into the Wealthsimple app, we can see that my account is up to $128,529. And if you've been following me for a while, you're going to realize that that number has come down. We're going to go into each account and we're going to see where some of the money's gone and why that happened. Keeping in mind, this is my real account with my real money, being transparent about things. So we're going to start off in my cash account. So this account pays me 4.5% interest monthly. And currently it holds $34,312. If you go back and you watch some of my previous videos, you're going to see that that total was slightly higher. We had a bunch of bills coming out of Christmas, and part of any good investing strategy is to have not only an emergency fund, but a savings account. I've combined them both because I get the highest return on interest by having both of them together. So this is our emergency fund and our savings account together. So it's only natural that we're going to be pulling some money out of our savings account when certain bills come up. For instance, with our property tax, which comes due annually, that money sits in this account accruing interest throughout the year, and then when it's time to pay it, we'll pull it out and pay it. So looking deeper into this account, right now we've earned $60.39 interest in this account for this particular, up to this particular point in the month. So another metric that I can share with you is that last month, as of January 31st, we made $145.79. All right, so here is the spreadsheet that I use to keep track of the Wealthsimple interest. Now this interest is taxable income. So what I do with this interest is I pull it out of my cash account and put it into my RRSP, and that way I can withdraw it later in life when my tax bracket's not quite so high. So in the 2023 year, from August to December, that's how long I've had the account, I made $607 in interest total. Obviously, it fluctuates as I put money in and take money out. The goal would be to try to keep this account slowly steady, and I do make regular contributions to it. So far this year in January, we've made $145.79. All right, so we're going to look at my kids' RESP. Right now, it's at $57,966. Now, we've had this account since the kids were really young and started putting money into it right away so we could take advantage of those government grants. And we do make regular contributions to it every month to take advantage of the grants, both the federal grants and the provincial grants. Now, this account is set up for a 90-10 split. This is the maximum risk level that Wealthsimple will allow you to have. This is a robo-advisor account, so we do pay some fees for it. Currently, Wealthsimple doesn't allow anybody to do DIY investing for their RESP. That's fine. It's just something less that I have to worry about, and I think it's worth the funds. This account has grown quite a bit, and the performance is doing really well. And as you can see, by the time my kids are 18, which will be in about 9 to 10 years, there should be about $225,000 in that account, and they can use that to go to school and everything to go along with it. And if you're not too sure what an RESP or how it works, you can watch this video right here. All right, so we're in my RRSP, and in that we currently have $16,031. So we'll go over some of the metrics about the performance of it. So over the day, and today the trading day has just started. We're about an hour into the trading day when I'm recording this. So right now we're up $125 for the day. On the month, we're up $107. On 3 months, we're up $892. And all time, we're up $1,072.81. That's 7%, so that's pretty good return so far. And keep in mind, I've only been trading since April of 2023, so about 10 months into things. Now this account is broken up into two parts. I have a Canadian account and a US account. When you hold over $100,000 with Wealthsimple, you're a premium customer and you get a free USD account. If you don't have over $100,000, you do have to pay for that account. So if you're new to investing and you really want to get started, I do have a referral link down in the comments. If you use my referral link, you'll get $25 right away, and I get a little bit of money back in my account as well. It'll get you up and running. You can actually start trading with as little as $1. It's a fantastic platform, and all your trades are free, so take advantage of it if you can. All right, so in my RRSP, we've had a few dividends that have come in. We had QQQY come in at $39, and that's in US funds. And we had VRE come in at 39 cents. That's not a big part of my portfolio right now. And then we had HYLD pay out $14.40. And if you're wondering why the dividends are so high for HYLD and QQY, it's because they are covered call strategies and pay a higher return. However, it may not be the right strategy for some of you because you are not getting any upside on your money. In other words, there's no growth in the stock value. The money that you put in will simply have a higher return month to month, but then you're not going to see any appreciation in that stock value. Okay, so this is the account that I highlight on my channel, which is my TFSA. My goal here is to max out this account. So I just want to give a big shout out to everybody that's subscribed to the channel. Currently we have 243 subscribers. Very interestingly, about 80% of people that do watch my channel don't actually subscribe. So if you're not subscribed, I would really appreciate it if you hit that subscribe button. It really helps out the channel to get the message out to other beginners, because that's really my whole goal here, is to make this sort of a little easier for people who are getting started. And also, if you hit that like, that's awesome. My highest performing video has 44 likes. I'm just wondering, maybe we can get that up to 50 likes. That would be absolutely amazing. All right, so performance-wise in my TFSA for the day, we're up $165. Over the month, we're also up $165. Over 3 months, same thing, we're up $165. And over all time, we're up $1,683, which is 9%. So that's pretty good. If we look back in time, if you go back and watch some of my early videos when I first started investing, things were red. In other words, they weren't in positive earnings. That's the nature of the stock market. So right now things are trucking along pretty well at 9%. That's great, but that's not the way it will always be, so don't count on that all the time. All right, so from the beginning of February, we've had 3 dividends come into the TFSA. We had REI, which is RioCan. It's a real estate REIT, paid out $2.43. We had VRE, which is the ETF that covers a lot of different REITs, paid out $1.72. And we had HYLD pay out $6.66. All right, so currently, as of today with trading, I have my regular $500 contribution. I did add a little bit more prior to filming. We're up to $660.81. I am going to chuck a little bit more money in there, and then we're going to go ahead and buy some stocks. Okay, so I've added some extra funds. We have $835.81 to trade with today. I'm a little heavily weighted in Canadian market, and I want to reduce that by diversifying out. So we're going to diversify into more of an international market. Today, we're going to buy 20 shares of XEF in our TFSA. Perfect, 20 shares I bought. And then the other thing we're going to do with the remaining amount of money, so we have $133. We are going to buy, based on my asset allocation model, I need to bring up those REITs a little bit, staying in that about 8% mark of my portfolio. And we're going to buy VRE. We should be able to buy about 4 shares of it. So there we go, we bought 4 shares of VRE. All right, perfect. And we have $11.57 left, and I always take that little bit remaining that's left over and I buy into QQC. Now my asset allocation is pretty high still there, but we'll work around that as we move forward. So we're going to do a fractional buy with the remaining funds. Perfect. And now we'll jump over and we'll talk about what XEF is. We'll talk a little bit more asset allocation stuff. So what is asset allocation and why is it so important? Asset allocation is how investors divide their portfolios among different assets that might include equities, fixed income, or cash, or something equivalent to that. Now, investors ordinarily aim to balance the risk and rewards based on the financial goals that they have and their risk tolerance and their time horizon. What does that all mean? Let's unravel that a little bit. It just simply means that you're putting your money into different things. So equities would be something like stocks, such as Tesla or Amazon would probably be the big ones that most of you know about. It could also be ETFs like VFV, which covers the S&P 500, or XEI that covers the Canadian market, or XIC, which also covers the Canadian market. Now, another asset class would be cash, and cash is pretty obvious. That's just simply money. These days, you could have your money just simply sitting in a savings account, which would be high interest. In my case, it's my cash account, but you could also have it in a cash ETF that earns simple interest as well. And the last asset class would be something like gold. Now, the truth is that there's no simple formula that will make the magic happen to improve your portfolio's performance based on your asset allocation. But the analogy I would use is if you put all your money into, say, Amazon, what would your returns be like? Well, if the stock did really well, then you would obviously have great returns. But that carries a big risk, because what if Amazon was to go bankrupt? Is that a possibility? It is. However, it may be very slight. It is a possibility. So by using diversity in your asset allocation, you're improving your chances of having your portfolio perform well. Okay, so we're in passive, and I want to show you my asset allocation. This platform has a great tool for you to set your own asset allocation, and so we're going to look at that in a little bit more in depth. Now, one thing that's nice about passive is if you're a Questrade user, you do get it for free. I'm a Questrade user, so obviously I get this for free, which is fantastic. The money that I save there, I then turn around and I'm investing with it. So when we scroll down into my portfolio, I took some time to analyze various asset allocations and came up with something that I think will work for now. And the nice thing is it can always change it. So here we're looking at my portfolio with all of the stocks, ETFs, and so on and so forth in it. And you can see on the right-hand side here, I've set all the percentages for how much of each asset I want to hold. So very top here we have VFV, and right now I've set that at 45%. And then right underneath that is the new asset that I introduced, which is XEF. And right now I've set the target for that at 16%. I only hold 3.5%, which is what you see here in the green, but we're going to build that up over time to meet that target of 16%. And then right underneath that we have XEI, and I have that currently set at 15%, and we continue on down. Now, the one thing that's nice is with my single stocks, I can set asset allocation. So I want to draw your attention to BAM. I've set that at 3%, but right now I'm actually overweighted at 7%. That's because I didn't use this tool when I started investing, and that's okay. I can make changes. So right now I've set it at 3. All that means right now is I could do one of two things, and passive can help us do that. Passive can make suggestions on what to buy or sell in order to balance your portfolio if you choose those settings. I don't have them set right now. You could do it one of two ways. One is it will look at the cash you have in your account and tell you what to buy or sell. And then the other way is you can tell it to set for selling when you don't have cash in your account, and it will look at your portfolio, figure out what you should sell and what you should then turn and buy. Now, in this case, it's pretty simplistic with VFV being at 45%. I'm actually overweighted at 50%. It's going to tell me you should sell that extra 5% of those VFV shares and turn around and put them into XEF simply because it's underweighted quite a bit. All right, so this week I bought XEF. Now, how did I come to the conclusion that I should buy this? This comes down to asset allocation and diversification in my portfolio and the way that I think that I should be diversifying. So right now, when I analyzed my portfolio, I was really heavily weighted in Canadian equities, and US. So the split there would be VFV in the S&P 500. And right now I hold individual stocks like TELUS, TD, and BAM, and then XEI. I'm really heavily weighted in Canada. Not that there's anything wrong with that, but I want to diversify out a little bit more into the rest of the world to make that portfolio a bit more broader, keeping in mind I do have 10 to 15 years before we're going to have to start using this money. So after doing some analysis, I came to the conclusion that XEF would be a good fit for my portfolio. Let's break down XEF a little bit so we understand what XEF is all about. So XEF is International Portfolio Diversification. The stock is one of BlackRock's products. It's a low-cost, simple way to own over 1,500 stocks from Europe, Asia, and Australia. You can always go to the website, and in this case, I'm on BlackRock's site, and you can see that it currently is returning 1.45%. That's year to date as of February the 13th, and that's constantly being updated, so you can go and find that information there on their website. So under the key facts, we can learn a little bit more about this particular ETF. The net assets as of February the 14th was $7 billion that they're currently managing within this ETF. It holds 2,627 stocks. It's all equity, and it's currently trading for $35.25 Canadian. So skipping down to the holdings part, we're looking at the number of stocks that are held within this ETF. And generally, most of the websites will show you the top 10. And generally those top 10 are the most weighted in the ETF, but they're constantly changing the weighting of those based on the performance of each individual stock. It'll break it down for the stock name, what sector it's in, how much the market value is, and what the weighting is. So for instance, in this case, the very first stock in here is in healthcare, and it's weighted at 2.11% within this ETF, and so on and so forth. And if we go a little bit further down into the website, it'll show you the exposure breakdown. So when I said I was heavily weighted in North America, this ETF broadens my exposure to, in this case, the top part is Japan at 24% of this ETF, the United Kingdom at 14%, France at 10%, Switzerland, Germany, and so on and so forth. And they show you on a map where those holdings would be. And lastly, something that's important, I think, for investors, depending on your goals and your age and your time horizon, is the distributions for the ETF. In this case, this one's distributions are semi-annually, so that means that it only pays out twice a year. And that might be important if you're getting closer to retirement and you want more of that monthly income. This might not be something you want to hold in your portfolio, but then again, it might be. Maybe you can rely more heavily on, say, some covered calls or some monthly distributions from other ETFs while you let this one continue to grow and pay out semi-annually.